We live, we live, we live. We live, we live. Are the bulls back? Are the bulls back in the market? Talk to me. There's opportunities under your feet. Who we got in the building? Talk to me. Who is in the building? I'm working on some merch. I'm working on some merch.
Ice cream, Dave Natch, clean. You and your team, they get rich. Everybody chill. See what I mean?
Please like the live.
Every day, you want your money at? Subscribe to Dave Natch. Food flow gas. Got a lot of money invested in a Dave play. Every day, you want your money at? Subscribe to Dave Natch. Food flow gas. Ton money, ton car meal, ton steering, ton wheel. Legal money and no drug deal. KFC, big deal. Sony, green sleeve, contract sign, done deal. Money a pour like gasoline. For ocean, river stream. Attach your case 20 gram. Western Union, we no go money gram. Money too, enough to hold in our hand. Some card, got the money where we have. After when the money full, buy a condo with swimming pool. Around with everything cash rule. To learn this before high school. Got a lot of money invested in a day play. Every day, you want your money hatch, subscribe to be a match. Food flow gas, got a lot of money invested in a day play. Every day, you want your money hatch, subscribe to the match. Food flow gas, rich.
Courtesy of DJ Concrete. DJ Concrete Face. All right, in the after hours, we have running, we have IO, we have Rave, we have C-Band, BORR, and the Age. That's what's running in the after hours. Let's see if they could continue tomorrow. Pay attention to Age, AGE. Started a position in the after hours. Let's see what happens tomorrow. I'm hot. Slut it. Today's play, SUNW, Sun W. They closed up 45% today at 406. Dave's bonus play, TLC, was done after half an hour. That's it. After 10 o'clock, the stock trended downwards. That was your signal to get out. What else was running today? Let me check Finviz. So CVV was the top runner today. CVV, they closed up 92%. Let's see what they're doing in the after hours. CVV. Oh, they're just up 0.87%. All right, maybe no continuation there. My battery's low.
Audio Renaissance presents A Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns, by John C. Bogle. Read for you by Tom Pinto. Dedication. Dedicated to Paul A. Samuelson, Professor of Economics at Massachusetts Institute of Technology, Nobel Laureate, Investment Sage. In 1948, his classic textbook introduced me to economics as a student at Princeton University. In 1974, his writings reignited my interest in market indexing as an investment strategy. In 1976, his Newsweek column applauded my creation of the world's first index mutual fund. In 1993, he wrote the foreword to my first book, and in 1999, he provided a powerful endorsement for my second. Now in his 92nd year, he remains my mentor, my inspiration, my shining light. Introduction. Don't allow a winner's game to become a loser's game. Let's start from the beginning. What is an index fund? It is simply a basket, portfolio, that holds many, many eggs, stocks, designed to mimic the overall performance of any financial market or market sector. Footnote. Please keep in mind that an index may also be constructed around bonds in the bond market, or even road less traveled asset classes such as commodities or real estate. Today, if you wish, you could literally hold all of your wealth in a diversified set of index funds, representing asset classes within the U.S. or the global economy. Classic index funds, by definition, basically represent the entire stock market basket, not just a few scattered eggs. Such index funds eliminate the risk of individual stocks, the risk of market sectors, and the risk of manager selection, with only stock market risk remaining, which is quite large enough, thank you. Index funds make up for their lack of excitement by their truly remarkable long-term productivity. This is much more than a book about index funds. It is a book that is determined to change the very way that you think about investing. For when you understand how our financial markets actually work, you will see that the index fund is indeed the only investment that guarantees that you will capture your fair share of the returns that American business earns. Thanks to the miracle of compounding,
the accumulations of wealth over the years generated by those returns have been little short of fantastic. I'm speaking here about the classic index fund, one that is broadly diversified, holding all or almost all of its share of the $15 trillion capitalization of the U.S. stock market, operating with minimal expenses and without advisory fees, with tiny portfolio turnover, and with high tax efficiency. The index fund simply owns corporate America, buying an interest in each stock in the stock market in proportion to its market capitalization, and then holding it forever. Please don't underestimate the power of compounding the generous returns earned by our businesses. Over the past century, our corporations have earned a return on their capital of 9.5% per year. Compounded at that rate over a decade, each $1 initially invested grows to $2.48. Over 2 decades, $6.14. Over 3 decades, $15.22. Over 4 decades, $37.72. And over 5 decades, $93.48. Footnote: these accumulations are measured in nominal dollars, with no adjustment for the long-term decline in their buying power, averaging about 3% a year since the 20th century began. If we use real inflation-adjusted dollars, the return drops from 9.5% to 6.5%. As a result, the accumulations of an initial investment of $1 would be $1.88, $3.52, $6.61, $12.42, and $23.31 for respective periods. The magic of compounding is little short of a miracle. Simply put, thanks to the growth, productivity, resourcefulness, and innovation of our corporations, capitalism creates wealth, a positive-sum game for its owners. Investing in equities is a winner's game. The returns earned by business are ultimately translated into the returns earned by the stock market itself. I have no way of knowing what share of these returns you have earned in the past, but academic studies suggest that if you are a typical investor in individual stocks, your returns have probably lagged the market by about 2.5 percentage points per year. Applying that figure to the annual return of 12% earned over the past 25 years by the Standard & Poor's 500 stock index, your annual return has been less than 10%. Result: your slice of the market pie, as it were, has been less than 80%. To make matters worse, as you will see in Chapter 5, if you are a typical investor in mutual funds, you've done even worse. If you don't believe that is what most investors experience, think for a moment, please, about the relentless rules of humble arithmetic. These iron rules define the game. As investors, all of us as a group earn the stock market's return. As a group, I hope you're sitting down for this astonishing revelation, we are average. Each extra return that one of us earns means that another of our fellow investors suffers a return shortfall of precisely the same dimension. Before the deduction of the cost of investing, beating the stock market is a zero-sum game. But the costs of playing the investment game both reduce the gains of the winners and increases the losses of the losers. So who wins? You know who wins. The man in the middle. Actually, the men and women in the middle. The brokers, the investment bankers, the money managers, the marketers, the lawyers, the accountants, the operations departments of our financial system is the only sure winner in the game of investing. Our financial croupiers always win. In the casino, the house always wins. In horse racing, the track always wins. In the trifecta lottery, the state always wins. Investing is no different. After the deduction of the cost of investing, beating the stock market is a loser's game. Don't allow a winner's game to become a loser's game. Yes, after the cost of financial intermediation, all those brokerage commissions, portfolio transaction costs, and fund operating expenses, all those investment management fees, all those advertising dollars, and all those marketing schemes, and all those legal costs and custodial fees that we pay day after day and year after year.
Who made
Beating the
money
market
today?
is
Talk to
inevitably
me.
a game for losers. No matter how many books are published and promoted purporting to show how easy it is to win, investors fall short. Indeed, when we add the cost of these self-help investment books into the equation, it becomes even more of a loser's game. The wonderful magic of compounding that is reflected in the long-term returns earned by American business, then, is translated into equally wonderful returns in the stock market. But those returns are overwhelmed by the powerful tyranny of compounding the costs of investing. For those who choose to play the game, the odds in favor of the successful achievement of superior returns are terrible. Simply playing the game consigns the average investor to a woeful shortfall to the returns generated by the stock market over the long term. Most investors in stocks, of course, think that they can avoid the pitfalls of investing by due diligence and knowledge, trading stocks with alacrity in order to stay one step ahead of the game. But the fact is that while the investors who trade the least have a fighting chance of capturing the market's return, those who trade the most are doomed to failure. For example, an academic study showed that the most active 1/5 of all stock traders turn their portfolios over at the rate of more than 21% per month. While they earned the market return of 17.9% per year during the period 1990 to 1996, they incurred trading costs of about 6.5%, leaving them with an annual return of but 11.4%, only 2/3 of the return in that strong market upsurge. Mutual fund investors, too, have inflated ideas of their own omniscience. They pick funds based on the recent performance superiority of fund managers, or even their long-term superiority, and hire advisors to help them do the same thing. But the advisors do it with even less success. See chapters 8, 9, and 10. Oblivious of the toll taken by costs, fund investors willingly pay heavy sales loads and incur excessive fund fees and expenses, and are unknowingly subjected to the substantial but hidden transaction costs incurred by funds as a result of their hyperactive portfolio turnover. Fund investors are confident that they can easily select superior fund managers. They are wrong. Contrarily, for those who invest and then drop out of the game and never pay a single unnecessary cost, the odds in favor of success are awesome. Why? Simply because they own businesses. And businesses as a group earn substantial returns on their capital and pay out dividends to their owners. Yes, many individual companies fail. Firms with flawed ideas and rigid strategies and weak managements ultimately fall victim to the creative destruction that is the hallmark of competitive capitalism, the formulation of Joseph E. Schumpeter in Capitalism, Socialism, and Democracy, 1942. But in the aggregate, businesses grow with the long-term growth of our vibrant economy. This book will tell you why you should stop contributing to the croupiers of the financial markets who rake in something like $400 billion each year from you and your fellow investors. It will also tell you how easy it is to do just that. Simply buy the entire stock market. Then, once you've bought your stocks, get out of the casino and stay out. Just hold the market portfolio forever. And that's what the index fund does. This investment philosophy is not only simple and elegant, the arithmetic on which it is based is irrefutable. But so long as investors accept the status quo of today's crazy quilt financial market system, so long as they enjoy the excitement, however costly, of buying and selling stocks, so long as they fail to realize that there is a better way, such a philosophy will seem counterintuitive. But I ask you to carefully consider the impassioned message of this little book. When you do, you too will want to join the revolution and invest in a new, more economical, more efficient, even more honest way, a more productive way, a way that will put your own interest first. It may seem far-fetched for me to hope that any single little book could ignite the spark of a revolution in investing. New ideas that fly in the face of the conventional wisdom of the day are always greeted with doubt, scorn, and even fear. Indeed, 230 years ago, the same challenge was faced by Thomas Paine, whose 1776 tract, Common Sense, helped spark the American Revolution. Here is what Tom Paine wrote. Perhaps the sentiments contained in the following pages are not yet sufficiently fashionable to procure them general favor. A long habit of not thinking a thing wrong gives it a superficial appearance of being right, and raises at first a formidable outcry in defense of custom. But the tumult soon subsides. Time makes more converts than reason. In the following pages, I offer nothing more than simple facts, plain arguments, and common sense, and have no other preliminaries to settle with the reader than that he will divest himself of prejudice and prepossession, and suffer his reason and his feelings to determine for themselves that he will put on, or rather that he will not put off, the true character of a man, and generously enlarge his views beyond the present day. As we now know, Thomas Paine's powerful and articulate arguments carried the day. The American Revolution led to our Constitution, which to this day defines the responsibility of our government, our citizens, and the fabric of our society. Inspired by his words, I titled my 1999 book, Common Sense on Mutual Funds, and asked investors to divest themselves of prejudice and to generously enlarge their views beyond the present day. In this new book, I reiterate that proposition. In Common Sense on Mutual Funds, I also applied to my idealistic self these words of the late journalist Michael Kelly. The driving dream of the idealist is that if he could only explain things to enough people, carefully enough, thoroughly enough, thoughtfully enough, why eventually everyone would see, and then everything would be fixed. This book is my attempt to explain the financial system to as many of you who will listen, carefully enough, thoroughly enough, and thoughtfully enough, so that you will see and it will be fixed. Or at least that your own participation in it will be fixed. Some may suggest that, as the creator both of Vanguard in 1974 and of the world's first index mutual fund in 1975, I have a vested interest in persuading you of my views. Of course I do. But not because it enriches me to do so. It doesn't earn me a penny. Rather, I want to persuade you because the very elements that formed Vanguard's foundation all those years ago, all those values and structures and strategies, will enrich you. In the early years of indexing, my voice was a lonely one. But there were a few other thoughtful and respected believers whose ideas inspired me to carry on my mission. Today, many of the wisest and most successful investors endorse the index fund concept, and among academics, the acceptance is close to universal. But don't take my word for it. Listen to these independent experts with no axe to grind except for the truth about investing. You'll hear from some of them at the end of each chapter. Listen, for example, to this endorsement by Paul A. Samuelson, Nobel laureate and professor of economics at Massachusetts Institute of Technology, to whom this book is dedicated. Bogle's reasoned precepts can enable
Nice
a few
10 grand
million of us
payday.
savers to become in 20 years the envy of our suburban neighbors, while at the same time we have slept well in these eventful times. The financial system itself, alas, won't be fixed for a long time. But the glacial nature of that change doesn't prevent you from looking after your own self-interest. You don't need to participate in its expensive foolishness. If you choose to play the winner's game of owning businesses and refrain from playing the loser's game of trying to beat the market, you can begin the task simply by using your own common sense, understanding the system, and investing in accordance with the only principles that will eliminate substantially all of its excessive costs. Then at last, whatever returns our businesses may be generous enough to deliver in the years ahead, reflected as they will be in our stock and bond markets, you will be guaranteed to earn your fair share. John C. Bogle, Valley Forge, Pennsylvania, October 20th, 2006. Don't take my word for it. Charles T. Munger, Warren Buffett's partner at Berkshire Hathaway, puts it this way. The general systems of money management today require people to pretend to do something they can't do and like something they don't. It's a funny business because on a net basis, the whole investment management business together gives no value added to all buyers combined. That's the way it has to work. Mutual funds charge 2% per year, and then brokers switch people between funds, costing another 3 to 4 percentage points. The poor guy in the general public is getting a terrible product from the professionals. I think it's disgusting. It's much better to be part of a system that delivers value to the people who buy the product. William Bernstein, investment advisor and neurologist, and author of The 4 Pillars of Investing, says, It's bad enough that you have to take market risk. Only a fool takes on the additional risk of doing yet more damage by failing to diversify properly with his or her nest egg. Avoid the problem. Buy a well-run index fund and own the whole market. Here's how The Economist of London puts it. The truth is that, for the most part, fund managers have offered extremely poor value for money. Their records of outperformance are almost always followed by stretches of underperformance. Over long periods of time, hardly any fund managers have beaten the market averages. They encourage investors, rather than spread their risks wisely or seek the best match for their future liabilities, to put their money into the most modish assets going, often just when they become overvalued. And all the while, they charge their clients big fees for the privilege of losing their money. One specific lesson is the merits of indexed investing. You will almost never find a fund manager who can repeatedly beat the market. It is better to invest in an indexed fund that promises a market return, but with significantly lower fees. Chapter 1. A Parable with a Moral. The Gotrocks Family. Even before you think about index funds, in their most basic form, mutual funds that simply buy all of the stocks in the U.S. stock market and hold them forever, you must understand how the stock market actually works. Perhaps this homely parable, my version of a story told by Warren Buffett, chairman of Berkshire Hathaway Incorporated, in the firm's 2005 annual report, will help clarify the foolishness and counterproductivity of our vast and complex financial market system. Once upon a time, a wealthy family named the Gotrocks, grown over the generations to include thousands of brothers, sisters, aunts, uncles, and cousins, owned 100% of every stock in America. Each year, they reaped the rewards of investing, all of the earnings growth that those thousands of corporations generated, and all of the dividends that they distributed. To complicate matters just a bit, the Gotrocks family, of course, also purchased the new public offerings of securities that were issued each year. Each family member grew wealthier at the same pace, and all was harmonious. Their investment had compounded over the decades, creating enormous wealth, for the Gotrocks family was playing a winner's game. But after a while, a few fast-talking helpers persuade some of the Gotrocks cousins that they can earn a larger share than the other relatives. These helpers convince the cousins to sell some of their shares in the companies to other family members and to buy some shares of others from them in return. The helpers handle the transactions and, as brokers, receive commissions for their services. The ownership is thus rearranged among the family members. To their surprise, however, the family wealth begins to grow at a slower pace. Why? Because the family share of that generous pie that American industry bakes each year, all those dividends paid, all those earnings reinvested in the business, 100% at the outset, starts to decline, simply because some of the return is now consumed by the helpers. To make matters worse, while the family had always paid taxes on their dividends, some of the members are now also paying taxes on the capital gains they realize from their stock swapping back and forth, further diminishing the family's total wealth. The smart cousins quickly realize that their plan has actually diminished the rate of growth in the family's wealth. They recognize that their foray into stock picking has been a failure and conclude that they need professional assistance, the better to pick the right stocks for themselves. So they hire stock picking experts, more helpers, to gain an advantage. These money managers charge a fee for their services. So when the family appraises its wealth a year later, it finds that its share of the pie has diminished even further. To make matters still worse, the new managers feel the compulsion to earn their keep by trading the family's stocks at feverish levels of activity, not only increasing the brokerage commissions paid to the first set of helpers, but running up the tax bill as well. Now the family's earlier 100% share of the dividend and earnings pie is even further diminished. Well, we failed to pick good stocks for ourselves, and when that didn't work, we also failed to pick managers who could do so, the smart cousins say. What shall we do? Undeterred by their two previous failures, they decide to hire still more helpers.
Big
They
up
recruit
Island
the best
Gal in the
investment
building.
consultants and financial planners they can find to advise them on how to select
Did you
the
sell
right
that
managers
GE as yet?
who will then surely pick the right stocks. The consultants, of course, tell them that they can do exactly that. Just pay us a fee for our services, the new helpers assure the cousins, and all will be well. Alas, the family share of the pie tumbles once again. Alarmed at last, the family sits down together and takes stock of the events that have transpired since some of them began to try to
You had them
outsmart
for
the
3
others.
years?
How is it, they ask, that our original 100% share of the
I don't
pie,
know. They're in big
made up
problems
each year
right
of
now.
all of those dividends and earnings, has dwindled to just 60%?
I'm hearing
Their
fraud.
wisest member, a sage old uncle, softly responds, all that money you've paid to those helpers and all those unnecessary extra taxes you're paying come directly out of our family's total earnings and dividends. Go back to square one and do so.
I guess he's just
immediately.
enjoying them dividends.
Get rid of all your brokers. Get rid of all your money managers.
The
Get rid of
stock
all your
been trending
consultants.
down for
Then
3,
our
4
family
years
will
now.
again reap 100% of however large a pie that corporate America bakes for us year after year. They did exactly that, returning to their original passive but productive strategy, holding all of the stocks of corporate America and standing pat. Exactly what an index fund does.
Never hope in this game.
And the Godrocks family,
They did good, okay. They did
happily ever
2%
after.
today. They're up 2% today.
Adding a fourth law to
I don't
Sir
know if you
Isaac
can see
Newton's
this.
3 laws of motion, the inimitable Warren Buffett puts the moral of the story this way. For investors as a whole, returns decrease as motion increases. Accurate
Every
as that
day is a
cryptic
learning
statement is,
process.
I'd add that the parable reflects the profound conflict of interest between those who work in the investment business and those who invest in stocks and bonds.
GE is really
The way
trying to
wealth
stay
for those in the
relevant.
business is to persuade their clients, don't just stand there,
Buffett took
something.
a stake in the company.
but the way to wealth for their clients in the aggregate is to follow the opposite maxim. Don't do something, just stand there.
They're trying to hold
For
it
that is the
together.
only way to avoid playing the loser's game of trying to beat the market. When any business is conducted in a way that directly defies the interests of its clients in the aggregate, it is only a matter of time until change comes. The moral of the story, then, is that successful investing is about owning businesses
What else
and
are you looking
reaping the
at?
huge rewards provided by the dividends and earnings growth of our nation's corporations. The higher the level of their investment activity, the greater the cost of financial intermediation and taxes, the less the net return that the business owners as a group receive. The lower the cost that investors as a group incur, the higher rewards that they reap. So to realize the winning returns generated by American business over the long term, the intelligent investor will minimize to the bare bones the costs of financial intermediation. That's what indexing is all about. And that's what this book is all about.
That's an old.
Don't take
old
my
stock
word for
pick.
it.
Is that
Listen to
Comcast?
Jack R. Meyer, former president of Harvard Management Company,
Let me pull
the
it up.
remarkably successful wizard who tripled the Harvard Endowment Fund from $8 billion to $27 billion. Here's what he had to say in a Business Week interview. The investment business is a giant scam.
Oh, Zion Oil.
Most people think they can find managers who can outperform.
Well, you
but
know what's
most
happening
people
with the
are wrong.
oil in the oil
I
sector
will say
right
that
now.
85 to 90% of managers fail to match their benchmarks.
It's all about the
Because managers
EVs.
have fees and incur transaction
Tesla.
costs, you know that in the aggregate, they are deleting value. When asked if private investors can draw any lessons from what Harvard does, Mr. Meyer responded, yes. First, get diversified. Come up with a portfolio that covers a lot of asset classes. Second, you want to keep your fees low.
CRK.
That means avoiding the most hyped but expensive funds in favor of low-cost index funds. And finally, invest for the long term. Investors should simply have index funds to keep their fees low and their taxes down. No doubt about it.
Oh, they're up
In
9,
terms that are a
10%
bit
today.
more academic, Princeton
Comstock.
professor
Okay.
Burton G. Malkiel, author of A Random Walk Down Wall Street, expresses these views.
Yeah.
Index funds have regularly produced rates of return exceeding those of active managers by close to 2 percentage points. There are 2 fundamental reasons for this excess performance. management fees,
Nice
and trading
gains today.
costs. Public index funds are typically run at a fee of less than 0.2%. Actively managed public mutual funds charge annual management and market expenses that on average are 150 basis points, 1.5 percentage points per year. Moreover,
Oh, this
index
stock don't
funds
move
trade
much,
only
huh?
when necessary,
Their
whereas active
52-week
funds
low was
typically have a
$4,
turnover rate close to 100%,
and their 52-week high
and often even
$8.50.
more, with trading costs of at least another 1.5
Oh yes,
to
penny
1% of
stocks.
performance a year.
They're
And probably
dangerous,
a
but
lot
you could
more.
make a lot of money
Active management as a whole
if you
cannot
catch them
achieve
early.
gross returns exceeding the market as a whole, and therefore they must.
MDCA. Excuse me. Hello, can I call you back? I'm doing a live. Yes. Tune in on my live. YouTube. All right.
On average, underperform the indexes by the amount of these expense and transaction cost disadvantages. Experience conclusively shows that index fund buyers are likely to obtain results exceeding those of the typical fund manager, whose large advisory fees
Did you open up that Webull account?
tend to reduce investment yields. Many people will find the guarantee of playing the stock market
Trading
game
starts
at
4
par every
a.m.
round a very attractive one.
You can
The
make some
index
quick
fund
money in
is
the
a
morning.
sensible, serviceable method for
Webull.
obtaining the market's rate of return with absolutely no effort and minimal expense. Chapter 2. Business reality trumps market expectations. Here begins the first lesson. That wonderful opening parable brings home the central reality of investing. The most that owners in the aggregate can earn between now and Judgment Day is what their business in the aggregate earns, in the words of Warren Buffett. Illustrating the point with Berkshire Hathaway, the publicly owned investment company he has run for 40 years, Buffett says, when the stock temporarily overperforms or underperforms the business, a limited number of shareholders, either sellers or buyers, receive outsized benefits at the expense of those they trade with. But over time, the aggregate gains made by Berkshire shareholders must of necessity match the business gains of the company. How often investors lose sight of that eternal principle, yet the record is crystal clear. History, if only we would take the trouble to look at it, reveals the remarkable, if essential linkage.
Yeah, my
between
place,
the
you gotta get
cumulative
in and out.
long-term returns
Soon as you
earned
get
by
a profit,
American
you get out.
business, the annual dividend yield,
Or you sell
plus
half.
the annual rate of earnings growth, and the cumulative returns earned by the U.S. stock market itself.
Unless I say it's going to be a long-term play.
Just look at the record since the 20th
Just be
century
careful,
began.
in and out.
The average annual
Don't
total
hold
return
and
on
hope.
stocks was 9.6%, virtually identical to the investment return of 9.5%, 4.5% from dividend yield, and 5% from earnings growth.
If you double your money,
That
you sell
tiny
half.
difference of 0.1% per year arose from what I call speculative return, depending on how one looks at it, perhaps merely statistical noise, or perhaps from a generally upward long-term trend in stock
I
valuations.
think I made 40% on SUNW
prices
this
for
morning
each dollar of earnings at
in the
the end of the
pre-market.
period than at the beginning. Compounding these returns over 106 years produced accumulations that are truly
I
staggering.
think Robinhood starts at
Each dollar
9:30.
initially invested in 1900
9
had an
o'clock.
investment return of 9.5%.
Yeah, you
rose
need
by
a
the
backup
close of
account. You need a Webull.
2005 to $14,808. Sure, few, if any of us have 106 years in us, but like the gut
4 a.m. It's a different ball game.
the miracle of compounding returns is little short of amazing.
Different ball game
Perhaps
pre-market.
the ultimate winner's game. Footnote. But let's be fair. If we compounded that initial $1, not at the nominal return of 9.5%, but at the real after inflation rate of 6.5%, the accumulation grows to $793. But increasing
As soon as the
wealth
news broke
nearly
this
8
morning
times over is not
on
to be sneezed at.
SunW, boom, I started
Yes,
a position.
there are bumps along the way in the
We
investment
will get the
returns
news early,
earned by
trust
our
me.
business corporations. Sometimes, as in the Great Depression of the early 1930s, these bumps are large. But we get over them. So, if you stand back and squint your eyes, the trend of business fundamentals looks almost like a straight line sloping gently upward, and those periodic bumps are barely visible. Note, however, that stock market returns sometimes get well ahead of business fundamentals. The late 1920s, the early 1970s,
Yeah, just check out my
the
link.
late 1990s. But it has been only a matter
I
of
think you
time
get
until,
3 free
as if drawn
stocks.
by a magnet, they soon return, although often only after falling well behind for a time. The mid-1940s, the late 1970s, the 2003 market lows. In our foolish focus on the short-term stock market distractions of the moment, we too often overlook this long history. We ignore the fact that when the returns on stocks depart materially from the long-term norm, it is rarely because of the economics of investing, the earnings growth and dividend yields of America's corporations. Rather, the reason that annual stock returns are so volatile is largely because of the emotions of investing. We can measure these emotions by the price-earnings ratio, which measures the number of dollars investors are willing to pay for each dollar of earnings. As investor confidence waxes and wanes, PE multiples rise and fall. Changes in interest rates also have an impact, uneven though it may be, on the PE multiple. So I'm oversimplifying a bit here. When greed holds sway, we see very high PEs. When hope prevails, moderate PEs. When fear is in the saddle, PEs are very low. Back and forth, over and over again, swings in the emotions of investors momentarily derail the long-range upward trend in the economics of investing. While the prices we pay for stocks often lose touch with the reality of corporate values, in the long run, it is reality that rules. So while investors seem to intuitively accept the idea that the past is inevitably prologue to the future, any past stock market returns that have included a high speculative stock return component
Fernie in
are
the
deeply
building.
flawed as a guide to what now lies ahead. To understand why past returns do not foretell
Yeah,
the future,
this game, it takes
we need
time.
only heed the words of
But
the
the
great
more you
British
do it,
economist John
the better
Maynard
you
Keynes,
become.
written 70 years ago.
Just hang in there
It
and
is
don't
dangerous
risk
to
too
apply
much
to the
money.
future inductive arguments
Start
based
small.
on past experience, unless one can distinguish the broad reasons why past experience
I think I lost for
was
3
what it
years
was.
straight.
But if we can distinguish the reasons why the past was what it was, then we can establish reasonable expectations about the future. Keynes helped us make
On
this
my
distinction
Robinhood account,
by
if I go
pointing out
all
that the state
time,
of
I think
long-term
I'm down
expectation for stocks
6
is a
grand.
combination of enterprise, forecasting the prospective yield of assets over their whole life, and speculation, forecasting the psychology
Yeah,
of the
I had
market.
to stop trading for a while
Chapter
because I
12
was
of the General
losing
Theory of Employment,
too much
Interest
money.
and Money, John Maynard Keynes,
So I took a year off.
1936. I'm well familiar with those words. For 55 years ago, I incorporated
Every day
them
is a
in my
learning,
senior
and then the
thesis at
market
Princeton,
keeps changing, so you
written
have to adjust with the
providentially
market.
for my lifetime career that followed,
Nah,
on the economic role of the investment
never
company.
give up.
The
Only
title I
losers
chose
give
for the
up.
thesis. This dual nature of returns is clearly reflected when we look at stock market returns over the decades.
You could take a break, but
Using
don't give up.
Keynes' idea, I divide stock market returns into 1. Investment return, enterprise, consisting of the initial dividend yield on stocks plus their subsequent earnings growth. Together, the essence of what we call intrinsic value. And 2. Speculative return.
Just
The
check out my
impact of predicting
playlist.
price
I got a
earnings
bunch of
multiples on stock
ebooks.
prices. Let's
You
start
could
with
play
the
at
average
night.
annual returns on
Believe
stocks
me,
over the
it
decades since
cements in your brain.
1900. The steady contribution of dividend yields to
I listen
total
to them
return
playbooks
during
every
each
night.
decade is always positive. Only once outside the range of 3% to 7%, and averaging.
And if you have a lot of stress,
4.5%.
forget about trading.
The contribution of
'Cause
earnings
your
growth to
mind gotta be
investment
right.
return, with the exception of the depression-ridden 1930s, was positive in every decade, usually running between 4% and 7%, and averaging 5% per year. Result? Total investment returns.
I think that was
which
my problem. I was going through a
dividend yield and
divorce
earnings
and
growth,
trading.
were negative in only a
doesn't
single
work.
decade, again the 1930s. These total investment returns, the gains made by business, were remarkably steady, generally running in the range of 8% to 13% per year, and averaging 9.5%. Enter speculative return. Compared with the relative consistency of dividends and earnings growth over the decades,
Yeah, just listen to the
wild
the
variations
playlist.
in
Check out the
speculative
ebooks
return
on my playlist.
occur as price-earnings ratios, PEs, wax and wane. A 100% rise in the PE from 10 to 20
But the
times
best
over
way to
a
learn
decade,
is
for
to
example,
do.
would equate to a 7.2% annual speculative return.
K last in the
Curiously,
building.
without exception, every decade of significantly negative speculative return was immediately followed by a decade in which it turned positive by a correlative amount. The quiet 1910s, and then the roaring 1920s, the dispiriting 1940s, and then the booming 1950s, the discouraging 1970s, and then the soaring 1980s. Reversion to the mean, RTM, writ large. Then, amazingly, we see an unprecedented second consecutive exuberant increase in speculative return in the 1990s, a pattern never before in evidence. By the close of 1999, the PE rate had risen to an unprecedented level of 32 times, setting the stage for the return to sanity in valuations that soon followed. The tumble in stock market prices gave us our comeuppance. With earnings continuing to rise, the PE currently stands at 18 times, compared to the 15 times level prevailing at the start of the 20th century. As a result, speculative return has added just 0.1 percentage points to the annual investment return earned by our businesses over the long term. When we combine these two sources of stock returns, we get the total return produced by the stock market itself. Despite the huge impact of speculative
I'm
return,
looking like I'm hot like
up and
Scotch
down
bonnet pepper.
during most of the individual decades,
Must be the red
there was
shirt.
virtually no impact over the long term. The average annual total return
coming
on
in
stocks
hot.
of 9.6% then has been created almost entirely by enterprise, with only 0.1 percentage point created by speculation. The message is clear. In the long run, stock returns depend almost entirely on the reality
What do you know
of the
about Scotch
investment
bonnet
returns
pepper?
earned by our corporations.
That's the hottest pepper in the
perception
world.
of investors, reflected by the speculative returns, counts for little.
That's
It is
that
economics
Jamaican
that controls
pepper.
long-term equity returns. Emotions, so dominant in the short term, dissolve. Even after almost 55 years in this business, however, I have absolutely no idea how to forecast these swings in investor emotions. I'm not alone. I don't know anyone else who has done so successfully, or even anyone who knows anyone who has done so. In fact, 70 years of financial research shows that
Okay, the best way to learn is to
but largely because the arithmetic
check out my ebooks
I believe
on my
I can forecast
playlist.
the long-term economics of investing.
You
with
could do
remarkably
paper
high
trade.
odds of success.
I don't know
Why?
which account you use,
Simply
but
because it is
Webull,
investment
Robinhood, they have.
returns, the earnings and dividends generated by
No, I don't think
American
Robinhood
business
has
that are
paper
almost
trading.
entirely responsible
Webull has
for the
paper
returns
trading.
delivered in our stock
Practice
market.
with fake money.
Put another way, while illusion, the momentary prices we pay for
I
stocks,
never paper
often
trade
loses
though,
touch with reality,
because
the intrinsic
it's not
values
real
of our
money.
corporations. In the long run, it is reality.
I have no emotion. If it's not
To
real
drive
money,
this point
I
home,
don't care.
think of investing as consisting of
I
two
got to practice
different
with
games.
real money.
Here's how Roger Martin, Dean of the Rotman School of Management of the University of Toronto,
But
describes
the
them.
best way to learn is to
One
just
is
do.
the real market, where giant publicly held companies compete, where real companies spend real money to make and sell real products
Just keep
and
a log
services,
of your trade.
and if they play with skill, earn real profits.
Write down how are you feeling
real strategy, determination,
when you made that
and expertise,
trade. How
real
were you?
innovation,
What's
and
your
real
frame of
foresight.
mind?
Loosely linked to this game is another game, the expectations market. Here,
Amazon
prices are not
closed up
set by
3%
real things
today.
like sales margins or profits. In the short term, stock prices go up only when the expectations of investors rise, not necessarily when sales, margins, or profits
I got
rise.
one share of Amazon.
To this crucial distinction, I would only add that the expectations market is not only a product of the expectations of active investors, but the expectations of active speculators, trying to guess what these investors will expect and how they will act as each new bit of information finds its way into the
That's the
marketplace.
thing with these pennies. They
The
always
expectations market is about
do
speculation.
that direct
The real
offering to
market
raise
is
cash.
about investing. The only logical
So,
conclusion: the stock market is
you got to
itself
get out of
a
them. Just
giant
make the money and
distraction
get out.
that causes investors
because they like to
Focus
do
on
that offering.
transitory and volatile investment expectations rather than what is really important, the gradual accumulation of the returns earned by corporate business. My advice to investors is to ignore the short-term noise of our emotions reflected in our financial markets and focus on the productive long-term economics of our corporate businesses.
And don't forget
Shakespeare could
bankruptcy.
have been describing the inexplainable hourly and daily, sometimes even yearly or longer, fluctuations in the stock market when he wrote,
A lot of these
like a
companies, they
tale
like to
told by
file
an
bankruptcy with your
full
money.
of sound and fury, signifying nothing. The way to investment
In and
success
out
is to
with
get
these
out of the
pennies, in and out.
expectations market of stock prices and cast your lot with the real market.
Hold a couple of
business.
days, take your profit out.
Don't take my word for it. Simply
Take your
heed the
profit out,
timeless
or take
distinction
your
made by
seed
Benjamin
money out
Graham,
and leave the balance.
legendary investor, author
And
of
let
The
the profit
Intelligent
do what it do.
Investor, and mentor to Warren Buffett.
Like Workhorse. Workhorse, I recommended that at $5. Workhorse went to $30.
But in the long run, it is a weighing machine.
So
Ben
sometimes
Graham
pennies could,
using his
become
wonderful metaphor of Mr. Market.
a good
The
start.
investor with a portfolio of sound stocks should expect their prices
Another
to
one
fluctuate
was
and should neither be concerned by
MCBR.
sizable declines nor become excited by sizable advances. He should always remember that market quotations are there for his convenience,
Yeah,
either
paper
to be
trade.
taken advantage of or to be ignored.
I don't know. Paper trade does nothing for
Imagine
me.
that in some private business you own a
Because I
small
know it's
share
not
which
real
cost
money,
you
so
$1,000.
there's no emotion.
One of your partners, named Mr. Market,
But
is
that's
very
a start.
obliging indeed. Every day he tells you what he thinks your interest is worth, and furthermore, offers either to buy you out or to sell you an additional interest on that basis. Sometimes his idea of value appears plausible and justified by business developments and prospects. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems little short of silly.
Yeah, it's not the same
If
because
you
it's
are a
not
prudent
real money.
investor, will you let Mr. Market's daily communication determine your view as the value of your $1,000 interest in the enterprise? Only in case you agree with him, or in case you want to trade with him. Most of the time, you will be wiser to form your own ideas of the value of your
In
holdings.
2008,
The true investor will do better
the Great
if he forgets
Recession,
about the stock market and pays attention to his
I can't
dividend
tell you how much I
returns
was
and to
down
the
that
operating
year.
results of his companies.
I was down 50% in my
Chapter 3. Casting your lot with
401k,
business.
50%.
Occam's razor writ large.
And I didn't sell. I couldn't
So
sleep,
how do you
but I didn't
cast your
sell.
lot with business? Simply by
It's a
buying
good thing because it
portfolio that owns
rebounded
the
the
shares
next
of every
year,
business in America and then holding
March
it forever.
2009.
It's a simple concept that guarantees that you will
Obama
win
made
the
a
investment
speech,
game played by most other investors
and the stock
who,
market
as a
rose
group, are guaranteed to lose.
for over 10 years.
Please
Never
don't
look
equate
back.
simplicity with stupidity.
Lionheart in the
Back in
building. Big up.
1320, William of Ockham expressed it well, essentially setting forth the precept that when there are multiple solutions to a problem, choose the simplest one. William of Ockham actually expressed it more elegantly. Entities should
Anybody
not be
made any money on
multiplied
S?
unnecessarily.
Sun W. Sun
But
W.
the
Anybody
point is
made money today?
unmistakable. And so Occam's razor came to represent a major principle of scientific inquiry. And so too is owning all
That
of U.S.
NND,
business,
I have no
the
luck with that
essence of
stock.
simplicity achieved by holding the stock market
I think the
portfolio.
last time I gained some money though.
For most of the past 80
In
years,
and out.
the accepted stock market portfolio was represented by the Standard & Poor's 500 stock index,
Yeah, you got to
created
check out
in
the
1926, and now holding a list of 500
go to
stocks,
Yahoo Finance
essentially
under
composed of America's
statistics
500 largest
and
corporations,
check out their balance
weighted
sheet.
by the value of their market capitalizations. The
Make
index
sure that their
originally
current
included just
ratio
90
is
companies,
over
rising to
over 1.
500 in 1957.
Current ratio must be
In
over
recent
1.
years, these 500 stocks have
Or else
represented about 80% of the market
bankruptcy
value
looms.
of all U.S. stocks. The beauty of a cap-weighted index is that it automatically adjusts to changing stock prices and never asks to buy and sell stocks for that reason. With the enormous growth of corporate pension funds during the 1950 to 1990 era, it was an ideal measurement standard, the benchmark or hurdle rate that would be the comparative standard for how their professional managers were performing. Today, the S&P 500 remains a valid standard against which to compare the returns earned by the professional managers of pension funds and mutual funds. In 1970, an even more
NNBM, I
comprehensive
think
measure
it
of
was
the U.S. stock market was
in
developed.
May.
Originally called the Wilshire 5000,
I
it
was
is now
up
named
over
the Dow
100%, and I
Jones
held
Total Stock
overnight.
Market Index. It
And the
includes
stock
some
was up
4,971
200% in the
stocks,
pre-market.
including the 500 stocks
So
in the
I was
S&P
up over
index.
300%, and
However,
I didn't sell.
because its component stocks
And
too
then
are weighted by
they
their
did an
market
offering.
capitalization,
They
those
did an offering
remaining
in, I think
4,471
it was
stocks
April.
account for only about 20% of its value.
And most of my
Nonetheless,
profit
this broadest of
went
all
down the
U.S.
drain.
stock indexes is the best measure
So
of the
I learned
aggregate
from that.
value of stocks.
As soon as I
therefore,
see
a
profit,
superb
I
measure
sell
of
at
returns
least
earned in U.S. stocks
half.
by all investors as a group. Of course,
You
the
got
two
to take
indexes have
profit.
very similar composition. Consider, for example, the 12 largest
Here
stocks
today,
of each
gone
and their
tomorrow.
weight in the construction of each index. It is hardly surprising that the two indexes have earned returns that are in lockstep with one
Don't
another.
hold and hope.
The
Get
Center
out.
for Research in
You could always
Security
get back
Prices at the University of Chicago has gone back to 1926 and calculated the returns earned by all U.S. stocks. Its data since 1970 have
Okay, I'm
provided
doing
a
this for
virtually
free.
perfect match to the Dow Jones Wilshire
I'm
Total
doing
Stock
this for
Market Index.
free.
In fact, returns of the two indexes parallel
I started
one
this
another
channel
with near
to
precision.
because I
From
was under
1928
quarantine.
through 2006, you can hardly tell
They
them
closed
apart.
New York City down late
For the
March.
full
So
period, the average annual return on the S&P 500
so let me challenge
was
myself.
10.3%. The return on the total stock market was 10.1%.
So let me talk about stocks.
Of course, this represents what we call a period-dependent outcome.
Actually,
Everything
someone
depends on the starting date
said I
and
should
the
stop
ending
doing
date.
real estate and talk
If we
about
began the
stocks.
comparison at the beginning of 1930,
Someone
instead
that
of
knew me really
1926,
well.
for example, the returns of the two were identical.
Soon as I start to talk
9.9%
about
per
stocks,
year.
my subscription
Yes, there are
skyrocket.
variations over the interim periods. The S&P 500
Plethora
was
of
much
people
the
started to
stronger, for
subscribe.
example, in 1982 through 1990, when its annual return of 15.6% outpaced the total market index return of 14%. But in recent years, 1998 through 2006,
My 401k
small and mid-cap
was,
stocks did better.
I decided which fund to put it in. So I had a mixed basket.
The 2.4% return of the S&P 500.
So I was in Vanguard
With a
and I
long-term
mixed it up.
correlation of 0.98 between the returns of the indexes, 1.0 is perfect.
But you know the
correlation.
managers, they took,
was
I think
little
they
to
took
choose between
1% or 2%.
Whichever measure we use, it should
To
now
manage
be
the
obvious
account.
that the returns earned by the publicly
So
held
I woke up, I
corporations
was
that
down
compose
50
the
grand.
US
I
stock
couldn't
market
sleep for
must of
weeks.
necessity equal the
But I
aggregate
didn't
gross
sell.
returns earned by all
And the
investors in
market
that
turned
market
around
as
to
a
the
group.
upside.
Equally obvious, as we'll learn in detail in the
A
next
lot of
chapter,
people jumped
the
through the
net
windows.
returns earned by these investors must of necessity
It wasn't
fall
a
short
nice
of those
time.
aggregate gross
2008,
returns by
early
the amount of
2009.
intermediation costs they incur.
Thought the world was coming
Thus,
to an
the
end.
reality of investing is that investors as a group must lose to the returns earned by business.
Yeah, okay, you gotta
This reality
keep your
is
losses
obvious. While
small.
owning the stock market over the long
I am
term
social
is a
in the
winner's game,
building.
beating the stock market is a loser's game. Such an all-market fund is guaranteed to outpace over time the returns earned by equity investors as a group. Once you recognize
I am
this fact,
social. You made
you
money
can see
today.
that the index fund is guaranteed to win not only over time, but every year and every month and week, even every minute of the day. Because no matter how long or short the time frame, yes, the gross return in the stock market minus intermediation costs equals the net return earned by investors as a
Stock
group.
market is the best game in the
data
world
do
right
not
now.
prove that indexing wins. Well,
Stock
the data
market
are
and
wrong.
real estate, trust me.
Over the short term, however, it doesn't always look as if the S&P 500 index, still the most common basis of comparison for mutual funds and pension plans, or the Dow Jones Wilshire 5000
Yeah,
index
no
is
good
winning.
place today, huh?
That's because there is no possible way to
TLC, if you
calculate
weren't
the
early,
returns earned by the millions of
no
diverse
money in that one.
participants,
TLC.
amateur and professional alike, Americans and investors in foreign countries, in the U.S. stock market. So what we do in the mutual fund field is calculate the returns of the various funds,
Still
counting
stuck?
each fund rather than each fund's assets as one entry. Since there are lots of small cap and mid cap funds, usually with relatively modest asset bases, they make a disproportionate impact on the data. When small and mid-cap
Okay,
funds
start
are
trading with
leading the
real
total
money,
market,
but small.
the all-market index fund seems to lag. When small and mid-cap stocks are lagging the market, the index fund looks formidable indeed. Nonetheless, the exercise of calculating how the returns earned by the stock market
I am social.
itself
I'm still
compares
practicing
with returns
options.
earned by the average equity fund
I'm
is
not
both
versed in
illuminating
options.
and
Trust me.
persuasive. If we
I
compare
don't
the
like to
results of what
recommend
are described
options.
as
It's too
large
risky.
cap core funds with the returns of the
Trust
S&P
me, I
500
almost blew my account
because of its
trading
market
options.
capitalization weightings, a
I
large
had to
cap
take a
core
year
index,
break.
the advantage of the index itself
I was
is
depressed.
impressive.
I don't like to lose money.
During the 37-year period, 1969 to 2006, the S&P 500 index fell into the bottom quartile
Yes, Kay, I
for
got
only
bitten
2
by
years and has not done so
by
since
that offering,
1979.
the first offering,
The index
NNDM.
has outpaced the
I'll never
average
forget it.
fund in 26 of the remaining
But it's okay
35
because I was
years,
up so much.
including 11
Even
of
with
the
the
past
offering, I
15
still
years.
came out with a little
Its
profit.
average ranking was in the 58th percentile, that is, outperforming 58% of the comparable actively managed funds, leading, as we shall see in the next chapter,
Tesla
to
moving
enormous
up.
superiority over time. It is hard to imagine that even
I
a
added
single
today.
one
I
of the
added
large
more
cap core
in
equity
Tesla
funds
today.
has a similar record of consistency.
Oh, you got in the
Consistency
low
matters.
low
A fund that is good or
330s.
very good in the
Okay,
vast majority of years produces a far larger long-term
that's a
return
nice
than a fund that is
entrance
superb in half
for
of the years
Tesla.
and a disaster in the remaining
I
half.
think they went up to
Single-year
four
rankings
something
then
today.
ignore the sheer arithmetic advantage of that consistency. In the coming chapters, the impact of that long-term consistency is cataloged over the past
You're a
25
crocus
years.
bag holding.
I should add that these annual data are what we call survivor biased. That is, that they exclude the records of the inevitably poorer performing funds that regularly go out of business.
You got to
As
get
a
rid of them
result,
crocus
this
bag,
further
K.
understates the success of the market.
We don't hold bags
strategy.
around here. I like to go
Investing
through
in
my
the first
portfolio.
index
Anything
mutual fund,
down over
$15,000
15%,
invested in
I
1976.
close that out.
Value in 2006,
I close out
$461,771.
all positions below 15%
Much criticism has been heaped on the S&P 500 for
until
its
the
choice
stock
of
turns
stocks,
around. Then I
often
go back
picking
in.
new economy stocks such as JDS Uniphase and Yahoo.
I never buy
near
on the
their
way
inflated
down. Never
peak
buy
prices
on the
during
way
the
down.
bubble,
Buy
just
on the
before
way
they
up.
crashed, taking on a growth bias at exactly the wrong time. While the criticism is valid, the excellent long-term record of the flawed index belies the existence of a significant problem. In fact, since
Lionheart,
the
very good.
early
It's
in
good to
2000,
take profit.
the S&P
Take some
500 has had
profits.
only a single significantly
It's going to be a
subpar
rocky
year,
road
2000,
until election.
3 years at about
It's going to
par,
be rocky.
and 3 years,
Make sure you have
2003,
your seat
2004,
belts
and
fastened.
2006, in the top quartile of its peers. I can't imagine that the vast majority of money managers wouldn't have been ecstatic with such an outcome. Thus,
So what are we
the
looking
recent
at for
era has not
tomorrow?
only failed to erode, but nicely
I got
enhanced the
AGE.
lifetime record of the world's first index fund, now known as Vanguard 500 Index Fund. Let me be specific. At a dinner on September 20th, 2006, celebrating the 30th anniversary of the fund's initial public offering, the counsel for the fund's underwriters reported that he had purchased 1,000 shares at the original offering price of $15 per share, a $15,000 investment. The value of his holding that evening, including shares acquired through reinvesting the fund's dividends and distributions over the years, he proudly announced, was $461,771. Now there's a number that requires no comment. Well,
Okay, you're never
comment.
stuck. You could always get
Of
out.
the 360 equity mutual funds
Your
then
first
in
loss
existence,
is
only
your best
211
loss. Your
remain.
first loss
This cumulative
is your
long-term
best
winning record
loss.
confirms that owning American business through a broadly diversified
An
index fund
elderly
is not
gentleman
only
told me that.
logical, but to say the least,
He had his
incredibly
house up for
productive.
sale,
Equally important, it is consistent
and the
with
first
the age-old
offer, he
principle
denied it.
expressed by Sir William
He
Lavaca.
declined the first offer.
Instead of joining the crowd of investors
You end up
who
having to
try
sell the
gain an
house
edge
at a
by
much
dabbling
lower
in
price.
complex
He
machinations
said he should have took that
involving
offer.
picking
Your
stocks and trying
first
to
loss
outguess the
is your
stock
best
market.
loss.
Two tasks that are
Don't hold
inevitably
an hope.
fruitless for investors in the aggregate. Choose the simplest of all solutions. Buy and hold the market portfolio. Don't take my word for it.
Yes,
Before you write off the value of the simple index fund solution,
very important.
recognize
The
that it has
entrance
been
and the
adopted as a
exits.
cornerstone of investment strategy.
That's
for
where you
many
got to
of
go to the
nation's
charts.
pension
Go to the
plans
charts and
operated by our
see
giant corporations
where the
and
support
state and
is
local
and where the
governments.
resistance is.
Indexing is also the predominant strategy for the largest of them all.
Or you
The
could go
retirement
into
plan
Yahoo
for federal
Finance, go
government
under
employees,
historicals,
the Federal Thrift Savings Plan.
and check the historicals
The
and the
plan has been a
prices.
remarkable success and now holds some $173 billion of assets for the benefit of our public servants and members of uniformed services. Under the plan, the various government departments automatically make a contribution equal to 1% of annual pay.
5 more minutes
and
on the
matching
live.
contributions of up to 5%
Gotta
of
get
pay.
some rest.
Meaning that a federal
Focus on
employee
these
who
plays
contributes
tomorrow
5%
morning.
of their salary to the plan receives a
And
total
plus I
matching
gotta trade
contribution
too.
of 6%. All contributions and
I gotta
earnings are
trade,
tax
I gotta
deferred
edit
until withdrawal,
videos,
much like the corporate 401k thrift plans.
multitasking.
Overcoming what must have been some serious reservations, even the Bush administration determined to follow the federal thrift savings plan model in its plan for personal savings accounts as an optional alternative to our Social Security program. Indexing is also praised across the Atlantic pond. Listen to these words from Jonathan Davis, columnist for the London Spectator. Nothing highlights better the continuing gap between rhetoric and substance in British financial services than the failure of providers here to emulate Jack Bogle's index fund success in the United States. Every professional in the city knows that index funds should be.
Okay, I really appreciate that. Please share the video.
Portfolio.
Okay, please share the video. I appreciate
the Vanguard
it.
Index Fund has produced a compound annual return of 12%, better than 3/4 of its peer group. At even 30 years on, ignorance and professional omerta still stand in the way of more investors enjoying the fruits of this unsung hero.
Big
of
up
the
to Cleggy
investment
for sharing my videos. I really
Chapter
appreciate
4.
you.
Why most investors lose to the market. The relentless rules of humble arithmetic. Before we turn to the success of indexing as an investment strategy, let's explore in a bit more depth just why it is that
COVID.
investors as a group fail to earn the returns
I
our
don't trust these
corporations
COVID
generate through
plays.
their dividends and earnings growth, ultimately
Let's see
reflected
what
in the long
happens.
run in the prices of their stocks. To understand why they do
Trump
not, we
recovered
need to
in 2
recognize the
days.
simple mathematics of investing. All investors
I
as a
think
group
Trump is a
must
fake, a
necessarily
phony, and a
earn precisely
fraud.
the market return, but only before the costs of
But
investing are
this is
deducted.
a stock show. This is not a
After subtracting
political
the costs of financial
channel.
intermediation, all of those management fees, all of those brokerage commissions, all of those sales loads, all of those advertising costs, all of those operating costs. The returns of investors as a group must and will and do fall short of the
Please
market
like the
return
live. Please
by
like the
an amount
live.
precisely equal to the aggregate amount of those costs. In a market that returns 10%, we investors together earn
Please
a gross
set your
return of 10%.
notification
Duh.
for my
But after we
uploads.
pay our
Next week
financial
I'll be uploading
intermediaries,
very
we
early.
pocket only what remains. And we pay them whether
Very
our returns
early.
are positive or negative.
5 a.m.
In investing as a group, we
Follow
get
me on
precisely
Twitter
what we don't pay
for
So if we pay nothing,
my
we
alerts
get everything.
at the petite.
There are then these two certainties. One, beating the market before costs is a zero-sum game. Two, beating the market after costs is a loser's game. Returns earned by investors in the aggregate inevitably fall well short of the returns that are realized in our financial markets. How much do these costs come to? For individual investors holding stocks directly, trading costs average about 1.5% per year. That cost is lower, about 1% for those who trade infrequently, and much higher for investors who trade.
Let me play my outro.
Out the road, the grass green, ice cream, Dave Natch, clean. You and your team, they get rich. Everybody chill. So what I mean to the world? Got a lot of money invested in a DAVESPLAY. Every day, you want your money at? Subscribe to Dave Natch. Food flow gas. Got a lot of money invested in a DAVESPLay. Every day, you want your money hatch, subscribe to the match. Put flow gas, turn money, turn car meal, turn steering, turn wheel. Legal money and no drugs deal. KFC, big deal. Solid, green sleeve, contract sign, done deal. Money a full like gasoline, full ocean, river stream. Attach a case 20 gram. Western Union, me no go money gram. Money too, enough to hold in our hand. Some card, got the money where we have.
Boom, bam.
After when the money full, buy a condo with swimming pool. Around with everything cash rule. Me learn this before high school. Got a lot of money invested in a day play. Every day, you want your money hatch, subscribe to the match. Foot flow gas. Got a lot of money invested in a day play. Every day, you want your money hatch, subscribe to the match. Foot flow gas, rich.
There you have it. Have a good night, ladies and gentlemen. I'll see you in the AM with the plays. I'm out. Boom, bam. I'm sure we have a couple of yardies in the building.